All right, so, we're all thinking about our next paycheck or maybe what groceries cost these days, but um, what if we zoom out a bit, and
Mm-hmm.
think about something really massive that affects all of us?
I like where this is going.
India's banking sector.
Yeah.
It's huge.
Yeah.
As of September 2024, we're talking about a system with something like $2 trillion in outstanding loans.
Wow.
And this sector fuels about half of India's entire economy. So yeah, if you've ever wondered what keeps the whole economic engine running, a healthy banking system is a big, big part of it.
It really is. When we talk about a healthy banking sector, it's not just some abstract concept. It's stability, it's growth, it has a direct impact on everyone. Businesses, how easy it is for them to get loans and grow, people like you and me, and how safe our savings are, and just like the overall economic landscape, the environment we all live and work in.
It's the foundation.
It is, absolutely. Understanding the health of the banking sector is really about understanding the foundation of our financial lives.
Exactly. And that is what we're diving into today. We're going to get a clear picture of the current health of India's banking sector.
Sounds good.
And how we're going to do that is by looking at two key indicators. Think of them as the vital signs, like a doctor would check.
Okay, I like that analogy.
Yeah, they reveal the underlying strength and resilience of this really critical part of the economy.
All right, so what are these vital signs we're checking?
We're going to look at non-performing assets. You probably heard of these. NPAs, people call them bad loans, and the capital to risk-weighted assets ratio, or CRAR. Okay, so let's start with those non-performing assets, the NPAs.
Right.
Now, the name sounds a little intimidating,
It does.
but the idea is actually really simple. Imagine this. You take out a loan to buy an apartment, right?
Mhm.
And you've got your regular monthly payments, your EMIs. Now, if you can't make those payments for 3 months in a row, well, the bank is going to classify that loan as a non-performing asset. It's basically in default.
Right, and that same principle applies, on a larger scale to businesses. So if a company fails to make their loan payments for at least 90 days, boom, those loans, they become NPAs as well. It's essentially money that the bank has lent out that's not coming back, at least not on schedule, and so it's not generating any income for them.
Right. So banks, they keep a close eye on this thing called the gross NPA ratio.
Mm.
And it's really just the total amount of these bad loans compared to all the loans they've given out.
Okay.
And this is interesting. As of September 2024, India's gross NPA ratio hit a 13-year low, just 2.5%.
That's really impressive. To fully appreciate how much progress that represents, we have to go back a bit. Between 2011 and 2018, India's gross NPA ratio actually reached a pretty concerning 11.5%. So
Right.
to go from that to 2.5%, that's not just a minor improvement, that's a major turnaround.
Yeah, a huge improvement.
It is. And it really shows that the steps taken to manage these bad loans and recover the funds are working. It's freeing up resources within the entire banking system.
It sounds like it.
Yeah.
And the picture gets even better when we look at net NPAs.
So net NPAs, they consider the fact that banks don't just sit around, and wait for these bad loans to magically disappear. They take action. They actually set aside some of their own capital specifically to cover potential losses from these defaults.
It's like a safety net.
Yeah, exactly. It's a financial safety net for those bad loans. So to get the net NPA figure, you take the total gross NPAs and you subtract the amount of capital the bank has set aside. Now in India, this net NPA ratio is even lower. It's fallen all the way down to just 0.57%. And that low number really indicates a much cleaner, much healthier loan portfolio for these banks.
So we have these two figures right now, a gross NPA ratio of 2.5% and a net NPA ratio of 0.57%. But how do we actually know if these are good numbers? I mean, are there any kind of benchmarks or something that tell us, what a healthy banking sector should look like?
Yeah, there are some generally accepted levels, some benchmarks that we use to kind of assess the health of a banking sector.
Okay.
Generally, a gross NPA ratio under 3% and a net NPA ratio under 1% are considered pretty healthy.
So we're good.
As of September 2024, India's banking sector comfortably meets these benchmarks, which is really encouraging. It's a positive sign of stability for the whole financial system.
That's definitely reassuring.
Yeah.
But our source material, it also gave us a glimpse of how other countries are doing, in comparison. How does India stack up globally?
That's a really important point to consider. While India's progress on reducing those NPAs is definitely noteworthy, it's also good to have a broader perspective. If we look at other major economies like Canada, the US, Denmark, the UK, their banking sectors tend to have even lower gross NPA ratios. often below 1.5%.
Oh, wow.
Yeah, so this suggests that while India has made some huge strides, there's still potential to improve.
Okay.
They could aim for even greater resilience in the future.
All right, so we've got a good understanding of where things stand with bad loans.
Yeah.
Now let's switch gears and talk about that other key indicator, the capital to risk-weighted assets ratio, that CRAR.
Okay.
This one sounds a bit more technical. Can you break it down for us? What does CRAR tell us about the health of a bank?
Sure. So CRAR, think of it as a measure of a bank's financial strength, its ability to handle potential losses, if things go wrong. Basically, it compares the bank's own capital, its own funds, to its risk-weighted assets.
Risk-weighted assets.
Yeah. So basically, risk-weighted assets, they're all the loans and things that a bank holds, but each one is assigned a weight based on how risky it's considered to be. Like a loan to a well-established company that might have a lower risk weight than, say, a loan to a brand new startup.
Makes sense.
Right. So the CRAR tells us how much of a capital cushion the bank has to absorb losses if some of these assets go bad.
So it can stay afloat.
Exactly. Especially during tough times like economic downturns or those, unexpected financial crises.
Like a financial airbag.
Perfect analogy. And to make sure the whole banking system stays stable, the Reserve Bank of India, the RBI, they set a minimum CRR that all banks operating in India have to maintain. Right now, that minimum is 9%.
So where does the Indian banking sector stand right now when it comes to this CRR?
Well, good news. The Indian banking sector as a whole currently has a CR of around 16.8%.
That's way above the minimum.
It is. It's significantly above that 9% minimum. So as our source material pointed out, the sector has more than enough capital to meet these regulatory requirements and to act as a buffer if there are any unexpected problems. It's a very positive sign for the stability of the financial system, and that stability ultimately translates into your financial security as well.
Okay, so that's really reassuring. Bad loans are down, and the banks have this nice capital cushion. Our source even included a graphic from June 2024 that seems to back all of this up.
Yeah, that graphic really helps visualize the data. It shows just how much lending is happening in India. The total loans were over 160 trillion rupees, which is like $2 trillion.
Wow.
And you can see on the graphic that the CRAR is steadily going up and staying well above that 9% mark. And at the same time, both the gross and net NPA ratios are going down.
Oh, good news.
It is. It's a really clear visual confirmation that the Indian banking sector is moving in the right direction.
Okay, so based on these two really important metrics, it sounds like India's banking sector is in a really good place.
It does.
But our source material, it takes a little bit of a turn at the end and starts focusing on the top banks themselves. Should we take a look at that?
Absolutely. What gets really interesting is when you compare the size of these banks based on how much they've lent out with how the market actually values them.
Okay.
That market valuation reflects investor confidence and what they think about the bank's future performance.
So if we look at the biggest banks, based on the total value of loans they've given out, their total assets, the top spot goes to the government-run State Bank of India, SBI.
Yeah.
Right behind it are two private sector banks, HDFC Bank and ICICI Bank. Now, HDFC Bank's assets are about half of SBI's and ICICI Banks are about a quarter. So SBI is definitely the biggest in terms of the sheer amount of money it has lent out.
That's right. Now, you might think that the biggest bank would also be seen as the most valuable by investors, but
That's what I would think. Isn't bigger better?
not always, at least not when it comes to the market. If we look at the most valuable banks in India based on their market capitalization, that's how the stock market values the whole company, the order actually changes. HDFC Bank is the most valuable, followed by ICICI Bank. SBI comes in third.
Interesting. So the bank with the biggest loan portfolio, it's not actually the one that investors think is the most valuable. And the source also pointed out that 4 of the 5 most valued banks in India are private sector banks.
That's a key observation. It suggests that the market, all those investors taken together, they seem to think that these private sector banks are more efficient, more profitable, and maybe they even have better management and governance compared to public sector banks. Even a giant like SBI.
Okay, and this is where it gets interesting. The source actually throws out this pretty provocative idea. It says, maybe the government needs to get out of the banking business.
Yeah, that's a bold statement. It definitely makes you think about the role of government in the banking sector. And it does seem like the market, the way they value these private banks so highly compared to even a huge public bank like SBI, they're saying something. It definitely raises questions about the best way to structure the banking system.
So let's bring it all together. We started by looking at NPAs and CRAR, And by those measures, India's banking sector looks to be in great shape.
Absolutely.
But then when we look at these top players and how the market values them, well, we see something different.
Right. So the big picture here is that while the Indian banking sector has become much healthier, investors seem to think that private banks are the ones that are going to be more valuable and more efficient in the future. And this isn't to say that public sector banks aren't important. They play a huge role, especially in making sure that everyone has access to financial services. But the market, the way they're valuing these banks, well, it seems like they prefer the way that private institutions do things.
Okay, so for everyone listening, what are the key takeaways from our deep dive into India's banking sector?
Well, the main takeaway is that as of September 2024, India's banking sector looks to be in a much stronger position than it was just 10 years ago. NPAs are down, capital adequacy ratios are strong, and overall the financial system just looks healthier and more resilient.
And that's good for everyone.
Exactly. And while India's banking sector is doing well, it's important to remember that there's always room for improvement.
Right. And then there's that interesting point about the market valuing private banks more highly than public sector banks. That's something to think about.
It is. That difference between banks like SBI, HDFC, and ICICI, it's really interesting. And it raises a question for you to think about. What does it mean for the future of banking in India if the market keeps favoring private banks? It's a question worth pondering.
Absolutely.
I think that's a good place to leave it for today.
Thanks for joining us.